Good morning, folks. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Tuesday, the 22nd of November, also known as Thanksgiving Eve. Did I get that right? Thanksgiving Eve? Yeah, that's how we roll, folks. I'm JD Durkin. Opening bell rung moments ago by Fisker Incorporated. The major indexes kicking things off in the green this morning as investors look to further comments from the Fed to get a better sense. At least they're going to try and get a better sense of the central bank's next move. Wall Street's also digesting the latest news from China, stoking fears of renewed lockdowns in that region over the country's nationwide COVID protocols. Let's take a look at what's on tap for this morning's show. We will be breaking down the most recent comments from Fed officials as the Street anxiously awaits the central bank's interest rate plans. What will they do in December? Plus, we'll dig into the FTX collapse even more as the embattled crypto exchange makes its debut in a bankruptcy court later today. And finally, all things Tesla, as that stock looks to bounce back from its two-year lows. Yeah, it was all good last year. What has happened to Tesla? For more on those stories and so much more, let's now bring in Mr. Martin Baccardax. Martin is the man in the know. He's our senior editor. He's our markets correspondent, and he is the person who helps us all get a little bit smarter on these issues every morning. Martin, good morning. Markets kicking off a day on a bit of a high note. What is driving, what at least drove the pre-market optimism? And what's top of mind for this trading Tuesday on this Turkey week?
Well, certainly stocks are a bit firmer than I would have anticipated, JD, so I can't speak to exactly what's driving it. It seems to be a combination of a few things. First and foremost, I think you alluded to it, there's liquidity in the market this week is not comparable to what it is previously. It's certainly a lot thinner. We had thinner trading volumes in pre-market, and that was the case in Europe as well overnight. So we are going to get moves as a result that might be sort of outsized compared to what we're seeing fundamentally. And that'll obviously be repeated tomorrow as well, heading into the Thanksgiving holiday. But if you were to look at the pullback in the US dollar, a retreat in Treasury bond yields, and just maybe a hint of dovishness from Fed officials, you can put those all together and maybe suggest that we would get a bounce back from last night's decline at the start of trading today. But as I look, I think we're up about a couple of hundred points on the Dow, and maybe 20 to 40 points up on the NASDAQ. Again, a little bit firmer than I anticipated. It will be interesting whether we can hold these gains throughout the session, but I do think it's probably that combination of a weaker US dollar, some dovish Fed signaling, and of course the thinner holiday volatility that we're seeing, holiday liquidity that we're seeing in global markets.
Thinner holiday liquidity we're seeing in global markets. Point well taken. Meanwhile, I do want to ask about mainland China. That nation reported its first COVID-related death since the start of the Shanghai lockdown. Now, according to state media, the three individuals were between the ages of 87 and 91, if I'm not mistaken. And this was actually something that broke the night before last. They also say those individuals had pre-existing health conditions. Any reason to think this might shift the nation's zero COVID strategy some more here, seeing as this is such an important issue even for domestic investors here at home?
Yeah, no question, JD. I think there were actually two more fatalities last night as well that the authorities reported very late this morning. So we're getting to the levels that we've seen on both infections and fatalities that peaked in April of this year. So we are moving, or at least China is moving in the wrong direction with respect to its COVID policies. Infection rates are rising, and now we're seeing lockdowns and restrictions and other things spreading across a host of cities. So that probably puts any pivot from Beijing officials on their China COVID policies well into the future, and that's going to have ripple effects throughout, obviously, the supply chain, the export story from China, the domestic demand story in China, which is increasingly important for a lot of American companies, and the ripple effects it will have on global economic growth. But what we're seeing now, JD, is sort of tighter restrictions on travel in and out of Beijing. The capital city schools are closed. There's all sorts of business closures there as well. And we're seeing these restrictions spread, again, as I mentioned, to several other large cities, including many which are key to manufacturing supply chains, both and indeed technology supply chains. So moving in the wrong direction. I was surprised again to see market reaction, because these numbers, which turned us red yesterday, are worse today than they were yesterday, but the market seems to be rejecting them for whatever reason. I can't quite understand. But that story, JD, I think is going to get more and more significant as we head into the teeth of December trading, because again, it's not, the simple fact is that the COVID policies there are not holding down infections and, in fact, are more broadly holding down the economy as infections rise. And that's the kind of downward spiral that officials would like to avoid, but they're staring it in the face at the moment.
Yeah, it seems as if out of well more than 1 billion people in that country, the nation's had a really unique challenge vaccinating specifically the population over 80 years old. And I wonder, Martin, is there much more that we know about the numbers, the vaccination process, and really what a lot of those challenges have been? Because I think from the outside, a lot of people would say, many other countries in the world have learned to live with COVID for good or for bad. It is imprecise. And there are communities and families that continue to be negatively impacted, even if it's not at the top of the headline coverage here in the West day to day. And they may look at these numbers and see these headlines out of China and kind of scratch their heads to say, what is the difference? How are we not all sort of aligned as a global community in terms of vaccination outrage? What do we know about some of those more unique challenges in China?
Well, vaccination rates in China simply just don't compare to those in the West, and there's a whole host of reasons for that. Official figures probably overstate exactly the number of people who have received at least 2 jabs, and the booster situation is also lagging behind, although at present they are trying to ramp that up as a result of the spike in infections. To put it charitably, it's more difficult to execute a kind of broad vaccination strategy across a country that's that big with 1.2 billion people. But a big portion of the messaging from the government ended up backfiring because people tended to be terrified of the disease as a result and actually weren't leaving their houses in order to go get medication and indeed vaccination as a result. And there were all sorts of other speculations about exactly the safety of the vaccine that was offered to Chinese citizens, which again was different to those that are offered in the West. So that's one portion of the reason. But what we're seeing at present is, again, these numbers aren't necessarily staggeringly high. We're still only around the 27 to 28,000 positive infection mark, at least at the official level. If we were to bump that number up by about 50%, it still would probably significantly underrepresent the number of people who are actually catching the disease and the new variants. But it's enough to, it's more about, JD, the country's health policy than it is the health of the country, if that makes any sense. Because the numbers are small, the country is big, and there's a lot of sort of natural immunity that's developed over the past 2 years. But I think the concern at this stage is more about exactly how the country is going to try to function around the reality of COVID, as you alluded to. And at present, they seem to have a strategy that is more of a blunt instrument rather than a nuanced set of guidelines. And that's the major difference in that country's inability to move past COVID compared to the West and indeed many of its neighbors in the Pacific region.
From time to time here, Martin, on the morning show, I do like to ask you about the strength of the U.S. dollar, given that that was such a big headline over the course of the last few months. Now, the dollar, the greenback, is actually retreating from its 10-day highs. I wonder if you're able to talk to us a bit about what is driving that action and what it may mean for someone watching at home.
It has a couple of components, at least this morning, I would imagine, JD. One is a sort of a risk-on sentiment, if you will. It's a phrase that people will use in financial commentary and indeed in financial markets that reflects a kind of ability or sort of the appetite for global markets to accept riskier trades on any given day. Risk-on is how it's described. And that tends to move in mirror opposite to the US dollar. The dollar tends to be a safe haven. When its value increases, it reflects a risk-off sentiment from global investors who are retrenching into more defensive positions. Today, we're seeing the opposite. The dollar is pulling back, and that's driving a bit of risk appetite. Now, the dollar is pulling back probably more on the function of these rather dovish comments that have come out of Fed officials over the past 24 hours, or at least the perception of dovish comments. And they are being reflected in futures trading as well. In the sense that there's about a 71% chance now of a smaller 50 basis point rate hike in December. That's down from about 85% this time last week and down from about 81% just a couple of days ago. It'll be interesting to see how those numbers hold because, again, liquidity is thin and lots could change, particularly over the Black Friday weekend if we get some really significant shopping numbers. But I think the sense is that there is at least an escalating view from global investors that U.S. inflation has peaked, and as a result, the Fed will begin to quietly and slowly recalibrate its assumptions for rate hikes, not only in December, but indeed beyond. That's going to pull the US dollar lower against its global peers, and that is going to add to risk appetite, absent a whole host of other things that could go wrong in the meantime. But I would imagine that's what we're seeing this morning, JD. We're seeing just a broader risk appetite that is a mirror opposite image to movements in the US dollar.
And if I'm not mistaken, Martin, you said we've gone from 85 to 71% chance of a 50 basis point hike for December.
Yes.
Did I get that right?
Yes, that's exactly right. We're moving down the scale to anticipation of a rate hike in December. We've had 4 in a row of 75. It's been one of the most significant tightening cycles that we've seen in pretty much any generation. And at the same time, the Fed is also selling bonds from its balance sheet, which is having an impact on market rates as well. So the composite tightening that we're seeing from the Federal Reserve has had a significant impact, as we know, on stocks and indeed the broader economy. And I think the expectation is now that that will be just tamed back a bit in December, and then the Fed will be able to more closely monitor data over the coming months before it's ultimately talking about any kind of pivot strategy. At present, JD, the numbers still suggest we'll get to that 5% level for the Fed funds rate in the springtime and stay there for quite some time. But the pace at which we will get there seems to be a bit slower than we had assumed maybe just a couple of weeks ago.
I hadn't planned to ask you this question, but I'm legitimately curious for the lens of history. If our terminal rate ends up being 5, even if it is as high as 7, as some have previously said, how does this compare to history? Where did the Volcker shock lead us in terms of their terminal rate? It was a fair bit higher, wasn't it?
It was more than twice, in fact, even if we were to get to 7. So I don't think it's something that would be historically significant. But again, as we've talked about in the past, JD, looking at those numbers in isolation don't really tell us the full story, because the American economy was operating in just such a different global environment in the early 1980s, where China wasn't necessarily, it wasn't even remotely the force that it is now in terms of global economic growth, in terms of its ability to export deflation with cheap consumer goods. The European Union hadn't formalized into the way that it is existing now, and we didn't have the European single currency either. Russia, Brazil, India, and China, the BRIC nations, hadn't evolved in terms of their economic growth. So the comparisons are really, I don't think, illustrative, given the meteoric changes, meteoric rise in these emerging market economies and the significant changes that we've seen in the broader economic picture over these past 30 years.
That's why I asked the question for context and perspective. Now, to this point about Fed officials, we did hear from one Fed official Monday, that's Cleveland Fed president, Loretta Mester. She told CNBC this: we've had some good news on the inflation front, but we need to see more good news and sustained good news to make sure that we are returning to price stability as soon as we can. So some data here has been positive, Martin, this we know, but doesn't seem as if there's really a whole lot there to suggest any departure on rates, to your previous point, right?
No, I think that's absolutely right. Fed officials have been at pains to lean against market expectations of a pivot or a pause or any significant alteration in Fed policy, because they just don't want the same mistakes that occurred in the end of last year, when there was still the discussion about transitory inflation and markets were reacting as to that. Today, the Fed is far more cautious, and it's attempting to explain not only that it's going to remain data dependent in the months ahead, but that even if it were to overcorrect in trying to hold inflation down, that would be better than not acting in a sufficient manner and allowing the longer term implications of inflation to embed themselves into the economy. I say all that to say the subtext of the Fed messaging is, yes, it's painful at the moment. It would be far more painful if we didn't do this. So we are left between a rock and a hard place. Short-term pain for eventual recovery, or a little bit less short-term pain for a longer recovery process. And I think the Fed would prefer that short-term pain and the prognosis for a better economy in the near term as a result of these higher interest rates.
Martin, we know that the Fed has been very clear that its goal in all of this is to get inflation back to a structural level of about 2%. But what is the possibility if it just not getting there and instead saying a bit more elevated than that for good? Can that happen? And if so, what happens? What does the Fed do?
It could happen. I think it's unlikely. I think the biggest shock that could drive inflation to the faster than expected rates that some people expect next year would be in the energy markets if we were to have a significant price spike as a result of either disruption in supply related to sort of the potential caps on the price of Russian crude, or sort of collective production cuts from OPEC or something like that. We could have an arithmetic increase in inflation rates. But the consensus view at this point is that by the end of next year, we're going to be very close to 2%, somewhere between 2 and 3% in terms of headline inflation, simply as on the basis of how we measure price changes. They are, of course, measured vis-a-vis the previous month and the previous year. So the headline inflation rate that we all look at, which is now at about 7.9%, is based on prices that were measured this time last year. So as we go into 2023, the basis from which the measurement will be taken will be lower. I do beg your pardon. The basis from which it will be measured will be higher, and therefore the future interest rates, inflation rates, will be slower. So we'll see that decline on a base effect, as it's called, into the months ahead. So I think it's very unlikely, barring a significant energy shock, that we will get higher inflation between now and when we speak this time next year.
Yeah, in a piece you filed early this morning at TheStreet.com, you noted that the gap between the 10 and the 2-year are signaling a bit of a recession. Can you explain this data point to people who have only a loose familiarity with it, and why this particular data point, Martin, is so closely watched?
It's very closely watched. It's one of the most accurate, although certainly not foolproof, recession indicators. It's basically described as the inverted yield curve. When you look at the rate of interest that U.S. Treasury bonds are paying out, you focus on the 2-year note and the 10-year note. When the rate that is being paid out on 2-year notes is higher than that of 10-year notes, that's called an inverted yield curve. Essentially, in a normal situation, the 2-year note should be lower than the 10. When the 2-year note is higher than the 10, again, it's called an inverted yield curve. And in many instances, it has preceded a recession in the U.S. economy. And indeed, every U.S. recession since the Second World War has been preceded by an inversion of that yield curve. More significantly, JD, what we're seeing at present is that the yield on 1-month Treasury bills is now higher than the yield on 30-year bonds. That's only happened twice in the last 3 years and about 4 times in the last 20 years. Each and every time it's happened, there's been a recession within 6 months. That tends to be the most significant predictor of recession. So the bond market is absolutely telling us that's where we're going to go. And they have been right many times in the past. So I think that's a bigger part of the reason why we're seeing that pullback in the dollar as well, because the assumption is that the Fed does see the economy tip into recession. It will have no choice but to pull back expectations of future rate hikes.
Martin, before we make a dive into stories including FTX and earnings, I wanted to give you the opportunity to address anything in the world of equities I did not otherwise ask you on a busy, it's a short week, but it's also a very busy week, isn't it, for Thanksgiving?
Yeah, there's more headline activity than I would have expected. I would imagine we'll certainly slow down notably into tomorrow's trading day. But again, I'm just surprised at the level of bullishness that we're seeing. Looking at the market now, it might be turning a little bit red, and that doesn't surprise me because the volumes are as thin as they are. But I am a little bit surprised that the market has been able to shrug off those rising infection rates in China. That, I think, is going to be the most significant story outside of the Fed in the coming week.
Absolutely. Okay, so to that point, let's move now, and I do want to get your perspective on the latest in the FTX collapse. It is only intensifying. Martin, can you walk us through some of the latest developments that we've learned since the last time you and I spoke?
Well, we'll have first day motions today in Delaware, JD, as a result of this Chapter 11 filing in early November. So this will be the first time that attorneys that are representing both creditors and debtors of the failed FTX will stand in front of the judge and start to discuss exactly how the mechanics of this case are meant to go forward. Today's might be a little bit on the dry side because first day motions tend to be about just carving out cash in order to pay suppliers, in order to pay the electric bill and, rents and all these other things that can keep the business, or at least the very core of the business, rolling whilst negotiations are hammered out with creditors and whilst you're still trying to figure out exactly where the assets are. There was some momentum in that regard, JD, last night. Papers filed suggest that cash on the collective books of FTX's businesses is worth about 1.24 billion US dollars. That's certainly more than anticipated. It's not nearly enough to cover what creditors are going to try to claw back. But it does suggest that John J. Ray is getting his arms around some of the sort of the granular data that sits inside this company, at least from a financial perspective. We're a long way from understanding the narrative, but at the very least, each day there are more building blocks being added to the understanding of how FX was able to collapse and indeed what assets remain as a result. There was also reporting from Reuters, which makes for uncomfortable reading in some respects, JD, and that does suggest that about $121 million worth of property was purchased by FTX, the company, but put into potentially the names of some of its key employees. The properties were purchased in the Bahamas, including a $30 million penthouse that was meant for key company employees. But these things are meant to be segregated and certainly aren't meant to be put into the individual names of those that worked inside the company. So that kind of malfeasance is going to be pulled out, I would imagine, of the business model as a result of these Chapter 11 processes. So that did make for interesting reading. And it does suggest that there's a lot more under the carpet, as it were, that will be revealed when it's pulled up in these Chapter 11 proceedings.
So to that point, let's talk a little bit more about what might be revealed with regards to alleged malfeasance. The company set to make its debut appearance in a Delaware bankruptcy court. Either what are some of the issues that are likely to be discussed here, or based on any experience you may have following comparable cases in a type of court like this, what does that discovery process look like? We've talked that this story has very quickly become a drip, drip, drip. Is this the sort of stage of the bankruptcy process where we are, as impossible as it may sound, likely to find out even more?
We won't find that out today, that's for sure. It's going to be a little bit more on the mechanical side, if you will, of how the process will go forward. They'll look at ways that they can pay bills, keep the water running, keep the electricity on, and all those sorts of things. And it will take sort of a very meticulous process going forward to understand exactly what happened. The first, however, of those processes is going to be establishing to some degree of validity the assets and the liabilities. That's really sort of, the day one install, if you will, of any Chapter 11 proceeding, because there's no point in going any further until you understand who is owed what and what is left from the business that is in this protection. It is worth remembering, and I always try to remind myself along the way, the Chapter 11 bankruptcy processes are indeed a protective bubble around a business operation from which it can emerge. There is the possibility that FTX could restructure its debt, find assets that could cover some of the liabilities, and come out the other side as a leaner operation with proper corporate governance, proper business structures, and re-enter the crypto marketplace. Now, my personal understanding of this, from what I have read and what I have observed, seems that that is unlikely, but it is nonetheless a possibility, and it's exactly what the Chapter 11 bankruptcy proceedings were designed to do. Give yourself some breathing room from the creditors and give yourself an opportunity for a second chance into the public market. So that may be where John Ray is headed at this point in terms of his observations of what the assets are, what the liabilities are, and where that company sits within the broader crypto business. That will will be very interesting going forward, because if he feels that that company can exit, that may suggest that this was more about incompetence rather than malfeasance. If it turns out that it was something even more, something worse, and if it was more built on fraud than anything else, the company probably won't exit as a result. That may be the dividing line, JD, between our understanding of whether this was just, again, incompetence or fraud or some combination of the two.
We had already talked so much about the supposed crypto winter before all of this happened, and somehow, incredibly, we've gone from a crypto winter to a crypto day after tomorrow scaled disaster of a winter. I mean, it has just, the whole thing has now been, and there's so many other names, right, that are thrown into turmoil and instability in the overall space. And I wonder if the overall crypto market can recover from this? I know many people will say yes, but does it look a lot different than maybe we once thought, especially keeping an eye on what regulators may look to finally do and lawmakers now that this has clearly reached a breaking point?
Yeah, I see. I think your earlier point was probably the best one in the sense that there will be an emergence or a reemergence of the crypto space, but it won't reflect the reality of what it was prior to the FTX collapse. Those days are gone, and I think most people understand that. And maybe some crypto enthusiasts would say that's a good thing, that you've washed out some of the more worthless tokens, that you've washed away some of the companies that were potentially not operating under the best faith or indeed the best ambitions of that broader market. And to be charitable, there is quite a bit of argument to be made about the ambitions of the broader crypto space, and some of it is good, and I can understand why people would be supportive of it. But FTX does not seem to have represented the best intentions of that, and as a result, it's probably a good thing that it's out of the way, at least in its former incarnation. So, will that mean broader confidence in the crypto space? That remains to be seen. We've seen such a significant drawdown in cryptocurrency prices from Bitcoin all the way down to sort of Ether and these tokens that are associated with exchanges and everything else. We're looking at what is the year-to-date decline now for Bitcoin, somewhere along the lines of 75 to 80% from the November 2021 peaks. We're trading at the lowest levels in 2 years. We've seen drawdowns of 90% and more for some of the lesser known crypto tokens, and certainly drawdowns that are similar to Bitcoin across Ether and other digital coins, and indeed even stable coins are suffering as a result of questions about how they are backed and by what assets they are being supported. So there is so much to pick through and such a level of opacity in some of these markets that confidence won't be able to return even with an FTX conclusion in its bankruptcy proceedings. So the crypto winter could last deeply into this winter and indeed well beyond. And I do think that when it emerges, it will certainly be entirely different from the way that we understood it in the first half of this year.
Yeah, you are correct. Bitcoin year to date down 66%, but it's 1 year, if you roll back to November of last year, is down just about 72%. Not what many people wanted to see who tried to get in, admittedly, probably pretty late on all of the hype. And you wonder to the percentage of, I had heard some crypto defenders, evangelists, if you will, in the last couple of weeks say, well, more people are holding on to their cryptocurrency. A higher percentage of holders are continuing to hold on for dear life, more than they ever have. And I wonder how many people, I think you and I have talked about this before, Martin, how many people kind of fell victim to buying in at that higher level after all the hype, and maybe they had a buddy or a cousin who got into it and they said, oh, I'm going to get into crypto. And now the numbers have absolutely tanked in the last year. And now they're stuck holding what little bit of the original bag they had. And they're like, what am I going to do? Just offload this? Or do I hope that over many years, maybe there's some miracle turnaround? I don't know. It's a fascinating time and a fascinating space. Do we have time for Disney? Oh yeah, go ahead. Go ahead. Then.
This is the most significant criticism that people have in the entire space, JD, is that the presumption of gain is more about making sure that new investors come in rather than the utility of the investment itself. And we know the name of the scheme that relies on that, and it begins with P. So this is exactly the kind of concern I think that people have had for such a long time. And I apologize for not knowing who published the data, because I do like to give credit when I find it. But there were figures last night that suggested that now more than 51% of Bitcoin holders are underwater. In other words, they came in to purchase at a level that now leaves them at a net loss. That is going to stress their ability to hold infinitum in order to protect and not extend the losses that they're already suffering from. So this could be an inflection point for the most significant of the cryptocurrency space, and indeed that could ripple through as well into the broader market of tokens that don't have the similar utility that Bitcoin does.
Yeah, it's just incredible. Before we head to rapid fire, I do want to let's squeeze in at least Disney here. Now that the dust has settled, I think the quick analysis that I've been hearing and reading, Martin, probably similar to you, is that Bob Chapek was much more of a parks specialist, right? He came in, he was a parks guy, and perhaps the moment for Disney demands a bit more. And while people are inclined to say, sure, maybe under Iger's first tenure, things weren't perfect, right? He's been criticized for like overpaying for the Fox deal, 21st Century Fox, et cetera. What is the prevailing thought a day and a half later or so about going back with Iger that you've been able to gather?
Well, I guess here's what I'll say about the Disney story, JD, and you can tell me if you think I'm right about this. Media people tend to be far more interested in stories about media than the broader world that isn't involved in media. So we are fascinated by this, I think, to a degree that the rest of the market, and indeed probably the rest of the world, is sort of scratching their heads going, why are you guys so into this story? There's a new CEO, they're going to try something different. It's no big deal. I do think there's some truth to that. I think we're 24 hours in to the tenure of a second-term CEO, and we don't know a great deal more today than we did 24 hours ago. And we certainly know the same things today that we knew a week ago. And those are the headwinds that are facing Disney in terms of its parks business as a result of the China COVID situation, in terms of its direct-to-consumer business as a result of it being more expensive to bring in new subscribers and to give them new content, and where we are on the linear cable business as a result of cord cutting. None of those things are going to be changed by bringing in a new CEO. Yes, he may be able to engender more trust amongst his employees. He'll probably have a better relationship with the board. And as a result, he'll have more productive conversations with activist investors. But if Disney was hoping that people would look to the future in a different way under Bob Iger than they did under Bob Chapek, I think they're going to be mistaken. This company still has a lot to navigate through, and a new boss isn't going to change those external dynamics anytime soon.
You know, it'd be an interesting on the street video series if you could, not that they would ever allow you to film at Disney World, but I'd be interested to know how many park goers at Magic Kingdom could name for you the Disney CEO. I'm just fascinated. It could be a very high number. Right. It could be an extremely low number. It could literally be the days that you and I go to Disney, and we are two of the only ones who happen to know that bit of information. I'm going to think a lot more about that question than I probably should. Okay, time now for our rapid fire. Just in time for the holiday season here, Martin. How could I not begin with this? Number one, why is Best Buy bullish on the upcoming season?
Yeah, I was surprised by this. This is an interesting story. Best Buy, of course, is the electronics retailer. They lever quite a bit off of Apple sales and PC sales and other things heading into the holiday season. And CEO Corey Barry said she expects this Christmas period to resemble more historical norms, if you will, in terms of shopping patterns. She thinks a lot of it is going to be collectivized around Black Friday and Cyber Monday, and that she's seeing spending patterns that are a little bit better than they had assumed just a few months ago. So they actually beat the street by about 35 cents on the bottom line of $1.38 per share. Revenues were down about 11% from last year, but they expect same-store sales, whilst they will be lower, they won't be as low as they thought a couple of months ago. So that, not necessarily bullishness, but certainly a little bit less pessimistic view, gave the stock a bit of a bounce in pre-market trading. I would imagine it's trading firmly again in the early trading, but it is kind of reflective of what a lot of CEOs are saying about this holiday period, JD, and that it will resemble more closely pre-pandemic patterns than previously anticipated.
Best Buy currently up 8.6% on the session. Spot on there, Martin. Number two, muted. What is behind Zoom's stock slump?
I think it's just a recalibration from investors as to what this company can do and what its value will be in a world in which we are not locked at home, but not locked in the office. I think Zoom is trying to do something correct here. They're trying to patiently build a business that will stick with us and be part of our working lives for a number of years ahead. But as a result, investors are going to have to do some significant re-rating with respect to how they value the stock and where they think it's going to trade based on revenue generation and profitability. Now, there were a couple of good things out of the Zoom numbers, I think. Their free cash flow is rising and their operating margins are moving in the right direction as well. But again, they're just going to generate revenue from business and personal customers at a slower rate than we anticipated, and certainly a slower rate than they did during the peak of the pandemic. And that is, of course, going to weigh on shares as a result. But I think this company is going to emerge as something that's reasonably rare, I think, in American commerce. And that is a company that offers a piece of working activity that we haven't seen before. Zoom was not part of our collective conscious prior to the pandemic. And now it seems to be one of those companies that has the privilege of being referred to as a verb. And that is something that's probably reasonably valuable, even though it's not recognized as so in the market today.
All right, number 3 is Tesla finally bouncing back, Martin, from its company's 2-year lows.
Well, it was a little bit higher in pre-market trading. At one stage, I think it was up about 1.7%, but that bid began to fade as we got closer to the opening bell. But this stock has been hammered so far this year. I mean, we're down about 58% so far year to date. Again, as you mentioned, we closed at the lowest levels in a bit more than 2 years last night. And the headwinds that are facing it are notable. We can go back to the situation in China where the Shanghai Gigafactory is located. And see blunted demand from a consumer perspective, and also the potential for further shutdowns or indeed supply chain disruptions that are pegged to cities, not only in Shanghai, but indeed around the country. And I think another thing, JD, that is not getting a great deal of attention, but will prove to be important in the fourth quarter earnings, is Tesla's Bitcoin holding. They have about 1.5 billion in Bitcoin that they invest, that they basically unveiled in the latter part of last year, that they are going to have to mark down as a result of changes in Bitcoin prices in the broader market. Now, essentially, the accounting rules for companies in the United States basically insist that if the prices of those assets were too high, you don't need valuation on the balance sheet. However, when they fall, you have to take a markdown. Tesla took a $170 million markdown in the third quarter. And as a result, they're going to have to take a significantly larger one in this quarter because, again, we're trading at levels of around 16,000 compared to 47 to 57,000 this time last year. So this is all being reflected in Tesla's share price, as is Mr. Musk's distraction with respect to his ownership of Twitter. It's going to be hard for that stock to get out of this doldrum.
All right, Martin, we're just about out of time. Thank you so much for a wonderfully substantive and informative conversation. As always, the great Martin Baccardax. Enjoy your Trading Tuesday, my friend, and we get to do this again tomorrow for Thanksgiving Eve proper. Martin, thank you.
Thanks, JD.
You got it, man. That's going to do it for the market open here from the floor of the NYSE. Stick with TheStreet. There it is on the screen for more on these and all of the major market stories that matter to you. We'll see you tomorrow.